What about investment banks? It was shocking, quite frankly, to see that the Fed bailed out Bear because it was something that had a pretty firm policy against doing for the entire modern era. In the US, we had taken the traditional view that investment banks could not be a source of systemic risk. Why was that? Well, for one thing, unlike a bank, where a bank deposit depends on the health of the bank if you want to get your money back, if you're a customer of an investment bank, I didn't say an investor, mind you, I said a customer of an investment bank, those securities are segregated. You don't really have to depend on the investment bank to get your securities out. And you're seeing right now a very easy, very straightforward lift out of Lehman Brothers of all of the accounts that they have, with nobody really afraid that they're not going to. In fact, Lehman is continuing to trade for you today. But they'll be lifted out and put in another investment bank with absolutely no harm. There's also SIPC insurance to back it up, so there's really not a risk that would cause customers to run, as there is in a bank where bank depositors do need to worry about the quality of their bank. The other argument was that investment banks hold mainly marketable securities. And that means that should they face a liquidity crisis, they can deleverage very easily, because all they need to do is sell securities so that their balance sheet matches their funding base. And finally, the argument was that you didn't need to worry about them from a systemic perspective because their access to the important clearing and settlement system was through banks. So you could really regulate investment banks indirectly through banks. We, in fact, had a test of that hypothesis, not one that anybody especially wanted to run, but the most profitable firm on Wall Street during the 1980s was Drexel, Burnham, Lambert. And in 1990, it was forced to go into Chapter 11 bankruptcy. There was absolutely no public intervention, except that the Bank of England and the New York Fed acted as honest brokers in order to unwind their positions. But it had so little systemic consequence that the stock market actually went up the day that Drexel Burnham went down. The EU, in contrast to the US, has long had the very opposite view of investment banks. Part of that is because almost all of the large European investment banks have long had investment banking powers, so they really don't recognize the difference in the category. The other reason is that the big 5 US investment banks all have important banking operations in Europe, usually in London, but also in other places as well. So earlier this decade, the EU insisted that we subject investment banks to prudential oversight comparable to that applied to large US banks. Now, we had a law that permitted us to do that. The Gramm-Leach-Bliley Modernization Act, which was passed in 1997, set up financial service holding companies where the Fed would be the supervisor, or they permitted the possibility of an investment bank holding company, which would permit the SEC to be the oversight supervisor. Investment banks, however, were free to decide to do it or not. None of them wanted to be regulated by the Fed, and one can well understand why not. Nor did they really want to be regulated by the SEC. The compromise that was arrived at was that they would become voluntary, consolidated, supervised entities with SEC oversight. And as far as we can tell, it amounted to none at all. The SEC has still not been able to describe what they did. Well, what's changed since the days of Drexel Burnham? Because that was a tough time too. The US economy was in recession. It was not a time when anybody really wanted to run an experiment of letting a major firm go. Well, it's not your father's investment bank these days. What's happened over time is that investment banks have become more and more like commercial banks. Their portfolios have shifted sharply in favor of lower quality, less liquid assets. They no longer have balance sheets that are mainly treasury bills and things they can sell in a trice. The proportion of leveraged loans, for example, has grown 8-fold from 2001 to 2007 on their balance sheets. The other thing that's happened is that their funding base and they themselves have become much more international. Now that could be a good thing because diversification in funding is usually a good thing, but it means that if you get into trouble, you're going to have to deal with the authorities in one country to take funds from that country to help you in the country where you may have a deficit. And typically, supervisors and regulators look after their own first, and so it becomes an inefficient. The other enormous difference in the investment banking business is that they've become much, much more leveraged. This isn't even counting the embedded leverage in the instruments that they hold, the swaps, the futures, and the CDOs and various sorts of securitized debts. This is just looking at net leverage. Bear Stearns had a 32-to-1 ratio, which is just incredible if you think about it. It works really, really well when profits are high, and that's why these firms were so profitable in good times. But it doesn't take much of a hit to turn such an institution into an insolvent institution. The other major change in investment banks has been the importance of repos. Now, repos in 1990 were about 13% of federally insured bank deposits. Repos last year were 60% of federally insured bank deposits. So repos have become a huge factor. We thought that it was a way for a firm to borrow without reference to its own credit risk. But somehow experts and the profession missed the point that counterparty risk can be very, very important. And as we've heard before, they've become very involved in all sorts of over-the-counter markets, particularly the credit default swap market, which is more than 60 trillion in size. Now, Bear Stearns was in a very precarious position. It was obvious as soon as their two hedge funds blew up, their equity price fell to almost nothing. Their liquidity position, which is something they really should have been watching at year-end 2007, was the lowest of the 5 investment banks. They were the most leveraged, and you could see in the credit default spreads against Bear Stearns that, in fact, they were much higher than for any other investment bank in January and February, and of course in March. Yet nonetheless, and I think Jeremy made the argument, and it is, I think, quite believable, the Fed was caught by surprise. The rapid demise of Bear Stearns really did startle them. The prime brokerage specialty, the thing at which Bear Stearns was really good, became a liability as the hedge funds grew worried and withdrew all of their funds. And you found that over-the-counter derivatives parties really didn't want to have them as a counterparty. They didn't want to take the counterparty risk. Lenders wouldn't lend to them, and some banks even refused to clear for Bear. So it was essentially dead. The Fed then did something really quite startling. They bailed them out. It was a shotgun marriage with JP Morgan Chase, but they put in $30 billion. It's true Chase will have the first billion in loss, but there's still $29 billion of taxpayers' money at risk. And it's at risk in a very untransparent way. In a world where SPEs and special purpose vehicles have gotten us in trouble, what did the Fed do? Well, they created an SPE and had it managed off balance sheet. Nobody's sure what's in it. They claim it's good quality stuff, but we don't really know. Why did the Fed do that? Why did the Fed make this incredible break with its past? Well, they were concerned that if we applied regular bankruptcy laws, now we don't do that to banks, but to investment banks we do, and we're seeing how the experiment works with Lehman Brothers. We by no means know exactly how it works. There are stays that are automatically applied, and these stays, which have a rationale of letting the court figure out what the assets are and what the liabilities are, and make sure that everybody gets paid in an appropriate way, can have a devastating effect on financial markets. It can cause counterparties to be unable to hedge, and the lack of clarity regarding positions can cause major failures. So we found a situation where the Fed was not willing to take a chance. What happened with Lehman Brothers? Well, one of the problems of intervening as the Fed did is that it creates moral hazard. And the moral hazard isn't just that investors won't monitor as well, not just that the investment banks have a bigger incentive to take risks. It's a moral hazard in solving the problem in a private sector deal. Why was it that it wasn't Sunday morning that we didn't know that Lehman wasn't going to find a partner? Well, they didn't fully believe that the Treasury and Fed would let it go. And there was good reason not to believe. Lehman Brothers was more than twice as large as Bear Stearns. It had all of the same interconnections. What was different was that the Fed knew a lot more about it, because as Franklin mentioned, they've had examiners in there every day since March. And the political factors may have well entered in as well, because they had just taken on $6 trillion with Fannie, Freddie, and the Federal Home Loan Bank system. So we're in a situation where we're playing an experiment that they were afraid to play in March. It's hard to argue that markets are in a much more stable situation, and we'll just have to see how it goes. Well, as I mentioned, one of the things that's gone wrong is risk management. A lot of the things we thought we knew about risk management turned out not to be true. And it's true of each of the traditional silos of risk management. Market risk. Well, typically, when you look at market risk, you use some sort of value at risk model that looks at prices. But as trading rooms increasingly trade in securities that are credit risk intensive, you've got to look at credit risk and liquidity risk as well. And most firms were simply not set up to do that. Credit risk also was a problem because people didn't really understand its relationship to liquidity risk. Operational risk proved a problem because most firms didn't have management information systems that could tell them what their full exposure to these markets were. And so you had this embarrassing series of announcements of even bigger and larger exposures and losses. And operational risk failed to have a good discipline for pricing these securities. There's an interesting BIS paper that shows the differences in pricing. Some of them were very naive, looked basically just at the ratings and had no real backup system. But there was also a failure across silos. There was a failure to anticipate that correlations were not going to be stable. There was a failure to realign risk management with the convergence of risk types. But I'd like to finish with a plug for a book that we're sponsoring at the Financial Institution Center. It's going to be called The Known, the Unknown, and the Unknowable in Financial Institutions. And I think it summarizes some of the lessons learned. Among the known, we thought we knew a lot about models, ratings, and insurance. And it turns out we knew a lot less than we thought we did. And things you think you know that just ain't so are really what can bite you in a big way. The unknown are things where there's sort of a big variance. You just don't really know with precision what the answer is. And the problem is that regulation is now insisting on a precision that's simply impossible. They're insisting that institutions have capital that will protect them against all but 0.03% of the risk of default during a year. And the fact is, we just don't know what those tails are like. And we're deluding ourselves by playing that. Finally, the unknowable. It may be that modern financial systems are simply so complex and the dynamics are so complicated that we really don't understand them and probably can't because they move very quickly. What's the answer to that? Well, that means that there's a lot of value in firms stockpiling liquidity, in extra capital, and in resiliency. The problem is, in a world of takeovers and aggressive hedge funds, it's not so clear that banks and insurance companies and other financial institutions can get by with having that kind of redundancy in their balance sheets. Thanks.